If you are planning to live or conduct business in a foreign country, you may save yourself thousands of dollars by claiming residency in the United States of America. It is probably not a big surprise that just like the United States, most countries around the world are running bigger and bigger deficit budgets. They can be quite aggressive in seeking out new sources of revenue, particularly when it comes to resident foreigners and multinational companies that may not be very familiar with local tax law. The good news is that the United States of America has tax treaties with many countries around the world that provide relief from double taxation. These treaties generally stipulate that certain items of income can only be taxed by the country of residence, or that the rate at which they can be taxed cannot exceed a certain level. For example, according to the tax treaty that the U.S. has with Spain, U.S. tax resident individuals can avoid having Spanish income tax withholding on income earned in Spain if they are physically present in Spain for less than 183 days in a 12-month period and are receiving income from an employer who is not a Spanish tax resident and does not have any permanent establishments or fixed bases in Spain. This is often very advantageous, as the rule of thumb is that the United States has lower tax rates than most West European countries. The U.S. federal income tax is proportional, with tax brackets ranging from 10% to 37%, which is usually lower than the corresponding rates for West European countries. For example, tax brackets in Spain range from 19% to 47%, with income that is usually considered middle class, such as $65,000 a year, taxed at a higher rate than the rate for the highest tax bracket in the United States. As you can see from the table, the highest marginal tax rate for $65,000 would be 45% in Spain. This is higher than the marginal tax rate for any income in the United States. This means that U.S. tax residents can take advantage of the U.S.-Spanish tax treaty to save thousands of dollars in taxes if they can prove that they are U.S. tax residents. In addition, individuals and companies deemed U.S. tax residents may be eligible for an exemption from value-added tax, a consumption tax similar to a sales tax imposed by numerous foreign governments. In fact, unlike the vast majority of countries, the U.S. has no sales or value-added tax at the federal level, so proving U.S. tax residency may exempt an individual or company from paying any value-added tax. Exemptions from value-added tax for U.S. tax residents are usually outlined in bilateral tax treaties. We are often contacted by individuals who are U.S. citizens spending a considerable amount of time abroad. These individuals are often deemed tax residents by foreign tax authorities, who then proceed to charge them with back taxes and penalties owed. Most foreign countries have a residency-based tax system, so you would generally be liable for income taxes on all your income, no matter what the source is, if you are a tax resident of that country. Countries imposing a wealth tax, such as Switzerland, Spain, and Italy, may also try to assess tax on your assets located in the U.S. or other countries. Non-residents, on the other hand, only need to pay tax on income that is sourced from that country or on assets that are located in that country in the case of countries imposing a wealth tax. The general rule for determining whether someone is a tax resident of a particular country is the number of days that someone spends in a given time period. This is quite often 183 days in a 12-month period, but some countries have a shorter window of time. For example, you could be deemed a tax resident of Switzerland if you spend just 90 days in a 12-month period there. Apart from the amount of time that one spends in the country, many tax authorities also consider other factors, such as ownership of real estate and maintenance of domicile through employment or other activities. U.S. tax residency certification may therefore serve as proof that a given individual or company is not a tax resident of a foreign country. This would mean that foreign taxing authorities would only be able to tax the given individual or company as a non-resident, only for income derived from and assets located in that given country. Finally, U.S. tax residency certification may be required when applying for citizenship, permanent residency, or certain visa types abroad. Tax residency certification in such cases does not yield any financial benefits, but is a required document that must be duly legalized, sometimes translated, and then submitted to the Foreign Immigration or Citizenship Authority. A&M Logos International is your one-stop solution for obtaining, legalizing, and translating your U.S. tax residency certification, also known as IRS Form 6166. We work with individuals, LLCs, C and S corporations, partnerships, trusts, and estates, making sure to prepare the appropriate forms and affidavits for each entity type. Every year, we help dozens of digital nomads, travelers, entrepreneurs, and international businesses reduce their tax burden by correctly applying for tax residency certification in the U.S. We also make sure to obtain the appropriate legalization depending on the destination country, getting apostilles for hate convention countries such as Brazil, India, Russia, and nearly all European countries, or undergoing the chain legalization process for countries that did not sign and ratify the hate convention, such as Nigeria, Thailand, and Egypt. Note that China and Canada are currently transitioning to becoming Apostille Convention countries. We can also provide certified translations of the documents to almost any language if necessary. Call us today at 212-233-7061 or email us at info@apostille.us for a free consultation on your particular situation. We will prepare all the necessary paperwork and work with the IRS to obtain your tax residency certification as quickly and as smoothly as possible while you focus on your travel and business goals.